features 3 speakers. All right, perfect. So the first one is Marissa Martinson. She is an estate attorney. The second is Art Feather, investment advisor. And the third, last but not least, will be Pat Wolf. She is a longtime supporter of the foundation. So, without much, pardon?
Is that a typo, member of Epilogue?
Epilogue Society.
Yeah,
so it is a typo.
Epilogue.
You have
I
good
didn't know
eyes.
it was
Well, with
I
that
just read
said,
Epilogue.
we're going to switch over.
I don't you don't find any of my typos.
There you go.
Okay, can everyone hear me okay? Okay. Hi, so I'm Marissa Martinson, as they said. I'm an estate planning attorney here in San Jose at Berliner Cohen. I specialize in estate planning, trust administration, probate, and then tax and gift planning. So a lot of things. So please ask questions at the end. So a little bit about me. I grew up in the Bay Area. I was born and raised up in Redwood City. And then I left and went to Davidson College in North Carolina to swim for them. And then I made my way back home to go to Santa Clara University to get my Juris Doctorate. Then I got a master's in tax from Boston University. So I spent a long time in school. That's all you need to take away from this slide. So lots of school. And I'm really happy now to be back home in the Bay Area. And working with my community that I started with to help them, prepare for all these difficult topics that you have to talk about as we age. All right, so why are you going to set up an estate plan? Okay, what is important about it? Why should you have one? There's a couple of reasons that we're going to talk about today. The first one is you want to avoid probate. You might not know what probate is right now, but you will before we leave today. You don't want to go to probate court. Next, peace of mind, right? A lot of you are probably really concerned about what your loved ones are going to do when you pass away, or maybe you're dealing with someone that passed away and you're trying to figure out how to get through this process. Another reason, privacy. As we will learn, probate court is public. Anything you file in the court, people can see. Estate tax, right? The federal government likes to tax us. They like to do it when we die also. Okay, so another reason to have an estate plan is kind of to prepare and plan for that. Lastly, legacy, which is a little bit of why you're all here today. Also, part of the Library Foundation goal. Some of you probably have foundations or charities or organizations that you really care about, and there's ways to benefit those after you pass away. So let's talk about probate, something no one likes to talk about. So, probate essentially is when you pass away, all of your assets that are currently in your name need to somehow make their way into the name of the people that you leave behind, okay? And so how you do that can be through a will, a trust, or probate court. So there's a lot more negatives to probate court than there are positives, okay? Probate court takes a very, very long time. Pre-COVID, it was taking 6 to 9 months, usually a year or more, to go through probate court and transfer the decedent's assets to all their loved ones that they left behind. Post-COVID, it's taking double that. The courts are incredibly behind on everything since COVID. They lost a lot of staff, so everything having to do with the court now is taking a very, very long time. Because it takes so much time, you can probably guess it's more expensive. Right? Anything that you have a lawyer doing and it takes more time, it's going to be more expensive. Also, working with courts is incredibly stressful. The court process is not simple, it's confusing, and trying to navigate that on your own or leaving your loved ones to navigate it, that's really difficult. So how can we work to avoid that, right? That's kind of what we want to know today. Basically, I hope your one takeaway from this, if you only have one takeaway, is you don't want to be in probate court. That should be your one takeaway today. Okay, so let's start with intestacy. This is kind of a weird word. So intestacy means that you pass away and you have absolutely no estate plan. You have no will, you've done nothing to prepare for death. You've done nothing to plan who gets what, who takes care of what, who in your family or your loved ones is going to be in charge and take action when you pass away. So, we all like to think that we get to make these decisions when we pass away, right? We want to be in charge of our assets. We want to know, we want to decide who gets what. I want my niece to get it, not my nephew. He's no good, right? So if you don't write it down, if you don't have a will, if you don't plan, California statutes get to decide. They decide who gets what and how much, all right? California is also a community property state. There are 9 community property states in the US. California is one of them. Community property, that means whatever you earn is equally yours and equally your spouse's. So if you are married when you pass away and you don't have a will in place, your spouse is guaranteed to get a certain percentage of that. And the percentages change if you have kids or no kids. If you are not married, then there's different rules and different percentages go to everyone. So again, you're not making the decision here, all right? The decision's already been made for you by the state of California. Okay, so most of you have probably heard of a will, right? We see it all the time on TV. They like to do those really dramatic readings of my last will and testament. I'm bringing my family here so I can read it to everyone. Sorry to break it to you, that's not real. We don't do that. We actually just mail it out. It's much less dramatic. So even if you have a will, you're still going to end up in probate court, all right? Your will has at least said who you want to be in charge. You might have tried to say who's going to get what. You still have to go to probate court. The court is still involved. They're still dictating some of the decisions. And we don't always like how that turns out. So we mentioned that probate's expensive. The California rules actually lay out how much attorneys are required to be paid in a probate. And so there's certain, I don't expect you to memorize this, there's not going to be a test. So essentially what happens is a certain percentage of all of your money is guaranteed to go to the attorney, just for handling your probate. Now, who else might get money out of your estate? Okay, so the attorney might be working on it. You also have someone called an executor. The executor is the person that you have left in charge. So I might pick my sister, she's smarter than my brother, I want her to be in charge. Guess what? My sister also gets paid for taking care of everything. So the executor, the person that is in charge of your will, if you're in probate court, they get paid just like the attorney. So there's the exact same fees going 2 places. It's like a double payment. All right, so probate can get expensive. And then we think back to how long this process is going on, how long your executor and your attorney are working with the court to do this. It can get expensive, and it takes a really long time, and it's confusing. There is a way to avoid probate court, and that's what we all want. We don't want to deal with the courts. Yeah?
What if there is no attorney and it's just the executor of the will doing all the work?
Then the executor gets the executor fee. They don't get both. But yes, you can do it. We call it pro se or pro per. You can do it yourself.
And what is the executor fee?
The executor fee is the same as the attorney. It's the same schedule of fees. So that's why if you have both, it's double the expense. The one con to not having an attorney is we like to think, we know most of the rules and the ins and outs of the court, because I will say a lot of the court forms are not very clearly written. They can be incredibly confusing to get through, but there are guides online and there are ways that you can kind of walk yourself through it. That was a good question.
I have another question. So these fees are left to the family, right, of the deceased to pay, or who pays?
Yes, so either it would come from the decedent's bank account, whatever they left behind,
Right.
or sometimes it might have to come from somewhere else, but typically it would come from the
From
decedent's assets.
Okay.
So if the decedent doesn't have enough, then people fight over money.
Mm-hmm.
It's unfortunate that people like to do that, but we see it a lot.
Okay.
So that's just the person that is taking it through probate?
Good questions. Okay, so we want to avoid probate. We probably all decided probate's bad. So there's something called a living trust, all right? So if you form a trust, I want you to think of the trust as a document that you've written where you get to make the decisions, okay? If you have this document in place, you can avoid probate court because you have laid out and determined how all of your assets are going to be distributed when you die. You've written out who pays taxes, you've written out who's in charge, you've planned for all the scenarios. Typically, while forming the trust might be expensive at the start, in the long run, it's more likely to be cheaper than going through probate. All right, so the one thing is it's flexible, all right? You get to decide who gets what and when. It's not the California laws dictating that, which we talked about earlier. All right, and another thing that you can do is if you go through the California laws, they're dictating everything. In your trust, you can actually find a way to leave money for a cause that you might care a lot about. Or for people who are outside of your family that you care about, like as if they were family, you can take care of them that way, which you can't do through the California laws. So let's talk about some more terms, okay? So if you form a trust, you have a trustee. The trustee is the person who is in charge. They are the person making all the decisions, and you have picked them to be in charge. While you are alive, you are the trustee, which means you're in charge of everything. You get to make all the decisions. The next term that we want to talk about is you're the one creating the trust. This means that you are the settlor. You are the person who created this. Okay? The settlor gets to nominate people to act as trustee if they can't. There's two reasons, primarily, that you would no longer be able to be in charge of your own trust. One, when you become incapacitated, if it's ever determined that you are not mentally able to make decisions anymore. Okay, we see this sometimes as people get especially elderly, dementia, Alzheimer's, some of those things, right? They're not able to make these decisions for themselves anymore. That's when we want a family member to step in. So whoever you named back when you did have capacity, they're now helping you make all these decisions. The second way you would no longer be in charge anymore is if you pass away. That's what would happen. So that's just like the main characters in our trust is the settlor, the person who created the trust, and the trustee, the person who's in charge. Okay, now there's a couple different ways that you can leave money to your beneficiaries, your heirs. So let's say that I'm 80, I'm making my trust, and I'm like, you know, my kids are like 50, 55. If I pass away soon, they're old enough to manage their own money, right? I like to think that I taught them enough that they can manage money. I'm gonna leave everything to them outright. They just get, if I pass away now, they can have all the money right away. I trust them not to spend it on something that they don't need or just blow it on a fancy car, okay? So you can leave it outright. Well, now I'm not so sure. Maybe my kids don't need all my money right away. Let's space out when they get it, okay? You can leave it in trust until a specific age. You can say they can get it when they're 40, when they're 30, maybe I trust them when they're 30. You get to pick the age. You can also do it in stages. Okay, they can get some when they're 25, they'll get some when they're 30, some when they're 35, and so on. You can decide all of this, right? Maybe they're 25, we'll test them out, we'll give them some money, they blow it, okay, let's have them learn from that experience, and then they can get some more at 30 and try again. So you get to decide that, you get to determine that. Maybe your child has special needs. They'll never be able to manage money on their own. Then it's probably gonna be held in trust for their lifetime. The trustee will take care of it, be in charge, and continue giving money to your child when they need it. Another thing you can do is creating your legacy, right? You could leave it to an organization that you care about. Maybe your kids don't care about the environment like you do, and you want to leave some money to a specific organization that works with climate change, or animals or some political organization. You can pick whatever organization you want to leave some portion to that you don't think your family would donate to in your honor.
So if you do the option of entrust to a specific age, you do it kind of in stages?
Yeah.
What happens if that person, God forbid, passes away before they've received the following payments?
Whoever's helping you set this up would ask you that exact question, and I would say, okay, if child number 1 passes away before they get everything, what should happen with the rest? Would it go to your other children? Would it go to that child's children, your grandchildren maybe, if they have them? Or could it go to a charity? You get to decide that.
Okay.
We like to go down the rabbit hole with all these decisions. We're gonna ask you the worst case scenarios and you're gonna hate us because we make you think about what happens when your children pass away. We like morbid questions, I'm really sorry.
It's kind of like what if?
We go through all the what ifs, exactly.
Okay.
You're exactly correct.
Okay.
And just to confirm, with a living trust, the trustee does not need to be paid, correct, if they don't want it?
They don't have to. No, you can they can be paid reasonable compensation for what they do. Sometimes trustees don't do anything for years at a time. So, but yeah, when you're setting it up, you can say, okay, my brother's in charge, he doesn't get paid.
Right.
But in the case he can't serve and my little sister has to do it, she can get money. You can decide that.
Okay.
And do they get taxed on it when they get paid, just like income tax?
So, okay, other important documents that you might do. We've talked about our will, right? We still want a will, okay? So in case you do not retitle all your assets into the name of the trust, we have the will, and we call it a pour over will because it kind of catches everything that you forget and it pours it into your trust and says, we forgot we had that bank account, it's still my individual name, I want it in the name of the trust, let's put it over there so it follows all the rules that I set out. Also really important in the will, the one thing a will does that a trust doesn't do is it helps you name guardians for your minor children. Let's say, we all like to assume, right, that we know who will take care of our children if we pass away. If you don't name them in a will, the court gets to decide. It might not be what you want. Say you love your parents, but you don't like your spouse's parents. Not uncommon. The court gets to decide. You have no say if you haven't put it in a will. Okay, so a will is very, very important. This is usually what holds people up. They can't agree on who should take care of their children because they all love their individual parents, right? So will is still very important with your trust. Next, a power of attorney. This document is the most important while you're alive. This document, basically, in the event that you are unable to make decisions anymore, you have nominated who gets to sign documents on your behalf, who gets to decide if you stay in your home or get put in a care facility. That's the type of document you want in place so that the court's not making decisions when you're incapacitated. As soon as you pass away, that document has no more power because it only matters while you're alive. Another document that might be important is deeds. If you own real property, you and your spouse probably took title to your property either as spouse A, spouse B as joint tenants, or spouse A, spouse B as community property. You want to put that into your trust so that when you pass away, the house is held in the name of the trust so it can get passed to your kids, or they can sell it and the proceeds can get passed to your kids. Another document that's important, we're in Silicon Valley, right? Everyone likes to have their own business. So if you have a business, if you have a limited partnership, if you have a limited liability company, a corporation, an interest in any of those, you have to retitle that into the name of your trust as well. Another document that's very important, beneficiary designations. This is not something that an attorney can do for you, this very last document. If you have an IRA, a 401k, you've probably named a beneficiary to get that when you pass away. Make sure you are updating those periodically. You might have named someone that passed away. You might have named someone that you are not close with anymore. You can name your trust because then the money from your IRA or your 401k will be distributed with the terms of your trust. I was telling one of your other speakers this morning, we had a case where husband and wife divorced, husband got remarried, his new wife, husband passed away, he never changed his beneficiary designation. Wife one got everything from his IRA and his 401k. New wife was not happy, okay? So you get divorced, great time to look at all of this again. Someone passes away, look at everything again. Someone's born, all of this. You really need to look at your beneficiary designations at work if you haven't done it in a while. Do not be new wife. Yes.
So, I already have beneficiary in all my banking and all financial accounts.
Good.
Do I still need a will or
Yes.
the other thing, the trust?
Yes, because, well, no, you don't, but yes, you do. So it depends, right? The lawyer's favorite phrase is it depends. So all of that is your beneficiary designations are taken care of, but anything else outside of that is not.
Will it go to probate? That's what's my original thought.
Those exact things should not.
Okay.
It's what's known as a transfer on debt account.
Okay.
So it's predetermined who gets it. So at least you have that in place, so that's good.
Can you designate your trust as a beneficiary?
You
Is that allowed?
absolutely, yes, and that is what I recommend. Your trust as the beneficiary, because then all the money will go to the trust and it'll go be distributed that way.
So the beneficiary designation overrides everything, as for one's okay.
Yes, so, well, yes, because a trust is not allowed to hold, you can't like put your IRA in there, you can just retitle it so that it's the beneficiary.
How about the bank account? Or bank account?
Bank account should be held in the name of the trust.
Okay, that's what I.
But your trust is the same taxpayer as you, so you don't file an extra income tax return. It's the same tax return that you always have, because it uses your social security number as the tax identification number. So it's no more it doesn't add a tax return to your yearly tax return.
So for beneficiary, do they change it after divorce or change it before?
You should change it if you don't like that person anymore, change it.
Okay.
Anytime, yeah. You're allowed to change this whenever you want.
So if you have a trust, even your day-to-day checking account, everything. should be-
Everything,
I was told that regular cash stuff, that's what they have, just your savings.
everything.
If your real property is part of a trust, when the first spouse dies, will your second spouse get a stepped up basis for it?
Yes. So, let me see. So step up in basis. So say your property is worth $1 million. If it's in the trust, when the first spouse, you bought it for $100,000. Let's use easy numbers. You bought it for $100,000. When spouse one passes away, it's now worth $1 million. So the basis is no longer $100,000. The basis is $1 million. Okay, so you've gotten this step up in basis. So if you were to sell the property right away when that spouse dies, there's no capital gain tax. That's a really advanced concept, so that's okay. But yes, you are correct.
But does that require some special documentation at that point? Or?
That would be on your tax return.
Isn't the 401k community property, you have to pay 50/50 to your spouse? Is that-
401k you can designate to whoever you want.
Oh, you could designate, okay.
All right, I'm gonna keep moving. 'cause we
Yeah,
gotta keep
my
moving.
question.
Okay, so, estate tax. I'm gonna go a little fast through this. This is what I said earlier. The IRS wants your money, okay? Every year, the amount of money that you can avoid tax on when you pass away goes up based on the inflation. In 2023, it's $12.92 million. If you have less than $12.92 million, you don't need to worry about this. If you have more than $12.92 million, we should talk later, okay? Because then you do need to worry about this, okay? I know, I have to use big numbers for examples. Okay, so gift tax. How many of you have heard about you can give gifts without paying gift tax? Okay, great. So this year in 2023, it's $17,000. It's adjusted for inflation every year, all right? So if you gift $17,000 to someone in a year, you don't have to pay a gift tax. You don't pay a gift tax, and you don't file a gift tax return. I found this on the web. Thank you. That's really helpful. She was trying to explain it for me. This gift tax is really important for some people if you're gifting. You can give $17,000 to as many people as you want. As long as you don't give an individual more than $17,000, you can gift it to as many people as you want. Okay. These two concepts, estate tax, which was the 12.92 really big number, and then this gift tax amount, 17,000, they work together. All right, so this is where I might lose you. Don't let me lose you, okay? So, you can make gifts during your life, okay? If you make gifts more than $12.92 million during your life, then you will be taxed when you die, okay? You'll be taxed on your estate because you've used up that entire gift amount, okay? So let's do a really quick example to kind of see how that works, okay? So John gifts $417,000 to his friend Robert, okay? John has never gifted money to anyone else in his life, okay? We just learned that $17,000, right, is you can give that every year without being taxed, okay? So what we're gonna do, John made a taxable gift of $400,000, right? Because that $17,000 I don't get taxed on, all right? So I can subtract that from that $417,000. So now I have to file a gift tax return on $400,000, okay? Because that was over that $17,000 number, okay? So you don't pay gift tax because I'm still under my $12.92 million number. Let's see how these are all kind of coming together a little bit. So now, because I'm getting taxed on $400,000, or I made a taxable gift, I have to subtract $400,000 from my $12.92 million number, so I'm down to $12.52 million. You guys might look at me like, 12.92, that's a really, really big number. But I am going to tell you that the 2017 Tax Cuts and Jobs Act that Trump put into place back in 2017, he's the one that got this number so high, 12.92, that Tax Cuts and Jobs Act. It's going to go away at the end of 2025. So on January 1, 2026, this number is going to be cut in half. So it's going to be down around probably $6 to $7 million by then. So it's changing. Just know that this stuff is always changing. So what I tell you today could be changed by Congress in 2 years. Okay, I have to speed it up. So we're going to skip the next example. So why should you gift? You need to donate to charity. You might want to reduce your estate taxes. I think most people want to be able to give to charity. That's kind of like the number one reason that they're donating. So you can gift cash, investments, real estate, tangible personal property, right? Mom's jewelry, dad's watches, artwork that you might have, and so many other things. There are so many ways to give. And you can do this through your trust, or you can do it while you're living. Both of those are equally valid options and are accessible to everyone. Donor advised funds are a really good way that you can gift. One advantage is that tax-free growth of your money. Someone else is managing it for you. So a downside is you don't have quite as much control, but you can give them money and say, invest it in something with the environment, and that way they combine your money with a lot of other people's money so it can do more good, right? Just you alone might not be able to solve a problem through giving, but when you and others combine to give the money, you can do a lot more good. So donor advised funds are a great way to do that. Another way would be for me to really, really confuse you on really complicated trusts that have to do with annuity interests and charities. And we can talk, I'm happy to stay and talk to some of you about those later, but those are some super advanced estate planning ways that you can gift if you want to do something really complicated. But just remember, it doesn't matter how you gift, but gifting is really important, and you can do that through your estate plan. I answered a lot of questions. I think we have to give it to Art now, but thank you guys for your questions. I really appreciate it.
And we'll be here.
Yeah, I'll be here after. You can come find me.
Thanks, Melissa. That was great. And with that said, we're going to switch gears and ask Art to come up. Art is an investment advisor with Transamerica.
Yeah, so my name is Art Feather. I'm an investment advisor representative with Transamerica Financial Advisors. I've been involved in investments and things for a long, long time. Have my own trust.
Way to go.
Yeah, way to go. And as I was telling Marissa, my father passed away last month, or actually in June, and thankfully he had a trust. So everything is going swimmingly well,
I like that.
which is the whole point here. So what I want to cover is a few simple, basic things that you can do even without a trust, even without a lot of planning necessary, and without a lot of expense. Okay, particularly in the form of legacy giving. So the first thing I have to do is put up some disclosures. You can read all that, but let me just tell you that as a registered representative and an investment advisor representative of Transamerica Financial Advisors, I'm not supposed to give tax or legal advice. You're supposed to go talk to your own attorney or accountant to figure that out. There's a couple of things that since I've been doing this for a while, a couple of very simple, common methods that people have been using to give legacy gifts. And legacy gifts, by definition, are gifts that are given after you pass away. All right? You control who gets what and how it comes out. The two common methods, life insurance and annuities. But I don't want to forget the fact that there's another way to give non-taxable gifts from your existing IRA. And I'm going to cover that as well in today's presentation. Now, when we talk about life insurance for legacy giving, it's really a very straightforward approach. You simply add or change the beneficiary of an existing life insurance policy. That's the first way. Most people get life insurance for various reasons, like you bought a house and you need mortgage insurance. You have children and you want to prepare, have enough money to cover their college education. For a variety of different reasons. But what happens after the children have finished college and are on their own? You still got this life insurance policy. You have two choices. Either flush it, meaning you lose the benefit of all the money that you put in, or make use of it as a way to give a legacy gift. Okay? And the nice thing about that is the nonprofit receives, or the a new beneficiary receives the entire face amount and insurance amount for that. The other thing you can do is start a new life insurance policy. A new life insurance policy requires all the things that you would normally have, which has good health, the ability to pay for it, and that kind of thing. The nice thing is, though, that the value of the life insurance today goes up over time. It's none of this, I just have a certain amount of insurance and as I pay, that's what I get. Life insurance you get today increases as you put money into the policy. And the money can be, quote, earning interest or invested in such a way that it actually grows faster over time. So many times faster than inflation. So those kinds of things are very useful as a way to say, I give this amount of money, but it actually is going to grow and probably grow better than the money would if I just kept it and didn't do anything with it otherwise. Now, what are the benefits? The big benefit of using life insurance for legacy giving is that the cash costs for maintaining the policy are much, much lower than the ultimate benefit that you're creating for somebody, particularly for the nonprofit. So life insurance is all about a large payout for a smaller amount of payment in. The issues, I talked about it briefly. the donor or the insured needs to be insurable at a reasonable cost, and you have to make the premium payments as necessary. There are ways to have single payment life insurance policies. So you put one semi-large amount into a policy, and you get insured for, and the benefit for the legacy purposes is sometimes 5 to 7 times what you put in, depending on your age. Now let's talk about annuities. Switch gears. Annuities are basically a way to take a sum of money, give it to an insurance company, and then they grow that money from the time of giving until the death of the annuitant. Pretty straightforward. All right? Annuities can be used for legacy giving by using either qualified funds, meaning money that comes from your 401k or IRA, or money that's just cash, non-qualified money. But the benefits are paid tax-free on a qualified money contribution when it's paid to a nonprofit, because nonprofits do not pay taxes. So you can give money from an IRA or 401k, put it into the annuity, have it grow, you pass away, the nonprofit gets the full amount of the money that was in the annuity. The annuities, actually, there are two kinds of annuities that people typically use for this. One is called the fixed index annuity. That means it's not invested in the market, or various kinds of variable annuities that are invested in the market. And there are benefits to both, and most of the time the choice is based not on whether one is right or wrong, but how you feel about investing versus gaining just interest. Interest versus investing. What's the process for putting together an annuity for legacy giving? And we've done a number of these with clients who have named nonprofits as their beneficiaries. The way this works, that you basically deposit money into the annuity after working with an advisor to create the kind of, and select the right kind of annuity that you like. And they all have various features and functions that may be useful for you. You typically pick the donor as the annuitant. So when the annuitant passes away, the money is moved to the nonprofit. And if qualified funds are used, donors that are 73 years of age or older, which is the current RMD requirement, just have to make sure that they take sufficient RMDs from the qualified funds, either in this annuity or in some other annuity.
What's an RMD?
Required minimum distribution. When you're 73 and above now. Okay. Now, one point I'll make in the end here is that if you don't need to take the RMDs, meaning you don't need the money from the annuities or from your IRA, you can actually use what's called a qualified charitable distribution from IRA funds of up to $100,000 a year for those of you with lots of extra cash, and direct that money to a nonprofit. That is done in a way that no taxes are paid either by you because you didn't receive it, or by the nonprofit.
Can I ask the advantage of annuity over just naming a beneficiary? Like if you name the charity as your beneficiary, how's the annuity?
Annuities are nice because you don't have to worry about the investment of the money. It's not sitting in a bank account making 0.01%.
Your 401k or your IRA, I mean, you could name them as a beneficiary.
You could also do that.
Okay,
Yes.
I'm just asking, why would I do
Yes,
this? Right.
you're no longer working, you've taken the money out, you want to do some, maybe more interesting investing, and the annuity allows you to do that investing without, really losing any money. Right, so it's a good, it's not for everybody. I'll say that. I think the advantage is that it's peace of mind more than anything else. That you know you've done this for this organization, for this purpose, is the main reason to look for something like this. Benefits, the funds that are deposited in the annuity have the potential to grow over time. And that's a really great thing. You don't have to worry about it. You pick the kind of investments that you want to put in there, the way that you want it to be earn interest if it's a fixed annuity, things like that. The distribution on death is made directly to the nonprofit. No taxes are paid. Nobody has to worry about anything. Everything is done automatically. And there are no health requirements in getting an annuity, whereas in a life insurance policy, you do have the concern about being insurable. The only issues are that the funds need to be available at the time of creation or within a specified time. Most fixed annuities are single payment, whereas variable annuities, actually you can add money over time. And number of the clients that we have chosen variable annuities because they want to make contributions to this charitable fund that they're creating over time. So every year they make a new payment in there to collect additional funds. The availability of funds is a little bit limited. Almost all annuities do allow you to get at minimum of 10% free. There is a surrender period, typically 5 to 7 years on some of the annuities that are out there in the marketplace. Okay, now while this is not legacy giving, I think it's important to talk about, because for those people who are 70 and a half or more, one of the advantages you've got is to provide money to charity is what's called the qualified charitable distribution. You can distribute up to $100,000 every year from an IRA to a nonprofit. You just simply contact your custodian of your IRA and say, I want to give, let's say, $5,000 to the San Jose Library Foundation. Right? What the custodian does is takes $5,000 out of your IRA account, creates a check, sends it either to the Library Foundation or to you, but made out to the Library Foundation. And then you give it to the Library Foundation. No taxes are paid. And it counts as part of your required minimum distribution if you're a 73 or older. 100%. And that's really the extent of what I have. I think we could actually pass on to Pat.
Thanks so much, Art.
You're welcome.
Great. I can see everyone's brains like just going, right? Thank you so much for that, Art. Really appreciate it. And last but not least, we're gonna ask Pat to come through.
And I am on the board of the San Jose Public Library Foundation, and I've been involved with the library since the 1980s. I started on the Library Commission, served on that for 8 years, And when I went off the commission, I transitioned to the foundation and have been on the foundation ever since. I give, I serve, and I work with the foundation because I believe in libraries. I'm a library brat from way back. My mother didn't take me to the library, I took her. One of my favorite youth library memories was, well, I knew the children's librarian really well. She took me through autobiographies, biographies, fiction, she took me through everything in the children's section. And I got my library card, which was a children's library card in those days, stamped that I could take books out of the adult section. Because I had been through the youth. And I was so proud of that card. I think I was in the 4th or 5th grade. And I was just so proud of that card. And I went home with 10 books every week from the library. That was our maximum. So I am a library brat from way back. The first Girl Scout badge I got, other than cooking and some of the standard ones, was the book badge. Because I could read books, it was easy for me. I love books, I love libraries, I've studied in libraries. We never bought encyclopedias, and there was no internet when I raised my kids, because I took them to the library to research from first-person articles and magazines and all those things. I love libraries. So when they asked me to serve on the library commission, it made sense. I went there, I liked it, and I've been hooked on San Jose Public Library ever since. Why do I give? Because I can make a difference. I give every year. I give because I make a difference. And I see the programs where I'm making that difference, and I'll tell you about them in a minute. Why did I become a legacy member of the foundation? Because I'm 78. I'm not gonna be around a whole lot longer. And my kids don't donate money yet. They've got 3 kids in college. My money is gonna still work for the library. I'm still gonna make a difference. Nobody's gonna know who Pat Wolf was, and I don't care if anybody knows. But I'm still gonna be making a difference to the residents of this city. And what kind of programs? There's our online high school. If you're over 18 and you haven't graduated from high school, we scholarship. It's online. Everyone has a one-on-one mentor that works with them. And they graduate with a high school diploma and a certificate in either child care or home care or basic supervision or several other things. I don't remember them all. And if you are not sure if the library is a place to give, I recommend you take, and correct me if I'm wrong, Library Foundation people, I think it's the 24th of August, it's a Thursday at 6 o'clock, but you wanna be early, in the rotunda of City Hall to see the next graduation. Is that the right?
You got it right.
Yeah, I'm telling you, every time I go, I get tears in my eyes when those people speak. You hear a 45-year-old woman say, my kid wanted to drop out of high school. I had to do something. And he said to me, you didn't graduate. I have just graduated. You know, it makes a difference. You see people where English is a second language and maybe they graduated from high school in their country, come here to make themselves better positioned to get positions of earning a livable wage. Just maybe a few weeks ago, my husband and I went to a graduation ceremony for our Resilience Corps. These are first generation college attendees. And they tutor, lead after school child care programs or homework clubs to help get past the learning loss that happened in the pandemic. And then they're going to help anyway with people with their studies and their learning as they continue on. We pay these students, they're all college students, a wage of $25.31 an hour, which is higher than minimum and pretty decent. of the last group of kids, I call them kids, they would call themselves young adults, that graduated, I think there were 45 of them. 30 of them had guaranteed jobs at a livable wage starting in the following school year. 2 of them, in talking to people, and I'm sure there were others, but I don't know, said they were changing their career plans to go into teaching because they found out they liked working with kids and they could teach. Now, we need teachers everywhere. They also focus on the zip codes in San Jose that have the biggest need for socioeconomic support. Zip codes like 95111, 95113, 95116, they make a difference. We make a difference in the lives of the youth that learn and of the kids who teach. And once a month, these students, the leaders, go to a program that teaches them how to write a resume, how to apply for a job, how to do this, how to do that, things that they need to succeed in life as an adult. We make a difference. I got really hooked on the Library Foundation when we were very small. And one of the only programs we really supported that I could grab on was the literacy program. And I went to their graduation and I got their books with essays and poems written by these people who 2 or 3 years earlier couldn't speak a word of English. And they stood up and talked to us. We help sponsor preschool programs, after school programs. That's where your money goes. We're not selective, we're for all the residents of this city. We're here to make a difference. When the pandemic hit and everything closed down, I am so proud to say that within 2 to 3 weeks, the library turned heel and started going online. But there was a downside to that. A lot of people in the zip codes I just mentioned didn't have computers. So the Library Foundation started collecting new and used computers, found companies that would refurbish used computers, and we started giving them out through the library. We kind of checked them out to have a system, but we checked them out for 3-4 months. We didn't check them out for 10 days or 2 weeks. We made it possible for these kids to go to school. We made it possible for people to continue to learn coding. We made it possible for adults to get to some programs that they couldn't have gotten to otherwise. And I had someone say to me, well, Pat, all these kids have a phone. And I said, and how would you like to go to school all day on a screen that's 2x2? I mean, my grandkids can use a phone much better than me. I mean, I text like this. And they're going, and it's done. But they still wouldn't have wanted to go to school on their phones. That's crazy. That's what we are. We're here to make a difference to the citizens of this city. So I give every year to the Library Foundation. And I give an unrestricted gift. People can give a gift to any of the programs they want. You can, give a gift to the online high school to help more kids, more adults go through that. You can give a gift to the Resilience Corps. I like to give it unrestricted so that the Library Foundation can use it. I consider my gifts to the Library Foundation an investment in the future of our country and our city. One of these kids may be our mayor in 25, 30 years and go on to be a governor. Who knows? But if we don't help them, if we don't invest in their future, we're not investing in our future. So that's why I care about the library. And the Library Foundation is my way to support the residents of our city, which I love. Thank you.